What is an assumable mortgage, and is this even a realistic scenario? Can you potentially get a 2.75% interest rate in today's interest rate environment where mortgages in general are around 6.5%? In this video, we're going to break down assumable mortgages, which types of loans might be assumable, a potential scenario, a case study that we can look at and see if this is a feasible option in today's market. If I haven't met you yet, my name is Connor Webb. I'm a mortgage loan originator licensed in Washington, Oregon, California, Idaho, and Arizona. If you're interested in getting pre-approved or if you have any questions, leave a comment in the comment below if there's a topic that you'd like me to cover. You can also visit leonardconnorwebb.com to reach out and get in touch. So assumable mortgages, what we're going to cover in this video is going to be what is an assumable loan, what types of loans are assumable, why are conventional loans in general not assumable, what is the process of assuming a loan, and then we're going to get into a scenario and is this realistic to assume a mortgage. And in the case study that we'll get into later on in this episode, here is a breakdown of the numbers and why this could be a big factor. I mean, in today's market, if you're looking at a 6.5% interest rate, a total potential payment on a $600,000 sales price, 3% down, would be about $4,600. Versus if you were able to get a 2.75% interest rate, of course, there is a much larger down payment requirement when you're looking at an assumable mortgage in order to make it pencil out, but your payment would be essentially half. We'll break down that scenario in full at the end of this video, but getting into it, what is an assumable mortgage? Well, essentially, an assumable mortgage is when you assume the existing mortgage on the property that you're looking to purchase. As it's described, this allows the buyer to take over the seller's existing mortgage, including the current loan balance, the current interest rate, obviously the total monthly payment with the principal and interest, all of the loan terms that are associated with that loan. Now, one thing to note is that actually about 23% of mortgages in general are assumable. So the overall amount of mortgages out there that you potentially could assume are relatively small. And what you'll see from the scenario later on in this episode is that a tiny percentage of purchases are actually done with an assumption because it would take so much upfront cost for the person that is assuming the mortgage to make it pencil out. Another factor is that the average close date for an assumable mortgage is somewhere in the 60 to 120 day range versus if you were to just get a new mortgage yourself, the standard close time is around 30 days. Assumable mortgages could make sense when current interest rates are higher than they were in the past. Obviously, in the 2020 to 2022 range, we were seeing loans in the 2 to 3% range. Currently, with rates being around 6.5 to 6%, it is a market where an assumable mortgage could make sense. Now, the entire process of assuming a mortgage is done with the current servicer of the time with that current mortgage. I myself wouldn't be able to assist in any way with an assumable loan because I'm not the one that's originating the loan. There's no origination a part of it. It's just the servicer and the current mortgage. Now, here's the complete process to assume a loan. First off, you have to confirm if the loan is assumable. In general, FHA, VA, USDA loans can be assumable, and most likely conventional loans are not assumable. You then would contact the current loan servicer to request the assumption application and the guidelines. The buyer would then complete a full qualification package, which would be pulling credit, looking at income, assets, employment. You're essentially having to qualify as if you were just getting a new mortgage yourself, although if there is a lower interest rate, it might help with your qualifying. The next step of it is the biggest potential downfall of assuming a mortgage, and this is determining how the buyer will cover the seller's equity. When someone is looking to assume a mortgage, let's say you're purchasing a property for $500,000, the current loan balance is $400,000, you're trying to assume that loan, you'd have to bring in the difference, that $100,000, in order to make it pencil out for the seller. The servicer then underwrites the assumption and verifies
the servicer
transfers the responsibility of the mortgage to the buyer. The servicer then underwrites the assumption and verifies both buyer eligibility and the loan status. There is then preparing the assumption agreement and closing documents through title and escrow, then closing the transaction with title, transferring ownership and the assumption agreement, replacing a new mortgage. So which types of loans are assumable? Well, in general, FHA, VA, and USDA loans are assumable and conventional loans are not. And the overall reason for this is that government loans are meant to support first-time homebuyers, veterans, rural buyers, people with lower credit, and they help with market liquidity during tough times. First-time buyers likely, if they have a lower credit score, are going to be going likely with an FHA loan. Veterans, that's where the VA loan comes into play, huge benefits for veterans. Rural properties are where the USDA loan comes into play. So government-backed loans are going to be more flexible than a conventional loan. And essentially, conventional loans are built for profitability and investor performance, not accessibility. With a conventional loan, a lender is lending you a certain amount of money, a large amount of money at a certain interest rate. They're looking to make their return. If all of these conventional traditional lenders allowed people to assume the low interest conventional loans at the 2-3%, then this certainly would destroy the investor return models and we would see the financial industry crumble. Now getting into each of these loan types, starting off with the FHA loan, mortgages that are backed by the Federal Housing Administration are the FHA loan. These are going to be loans that largely will benefit people with lower credit scores. In general, if someone has below a 700 credit score, they're probably going to be better off in an FHA loan for the short term. So why could assuming an FHA loan work? Well, as you'll see with these different loan types, a lot of the benefits and the drawbacks are going to be the same type of thing. Speaking here, many FHA loans from 2020 to 2022 are in the 2 to 4% range. Same thing with VA and USDA. With an FHA loan, as I described, there's easier credit standards. FHA assumptions don't require a perfect credit score. There also is no appraisal that is required, as essentially they assume that the value of the property is going up. The mortgage balance at the time of assumption is going to be lower than when they initially underwrote the loan, so there's no need to re-verify the value of the property. And then a negative of an FHA assumption, as I described at the beginning, the equity gap can be large. The buyer must cover the seller's equity with cash or a second loan in order for the assumption to pencil out. Then also the slow servicer process, which could take 60 to 120 days to close. And then also the buyer still has to qualify as if it's just a standard mortgage. Moving to VA loans, there are massive benefits for a VA loan for a veteran buyer. A VA mortgage is a mortgage that is guaranteed, at least a portion of that, by the U.S. Department of Veterans Affairs. It's very funky how the VA calculates the total eligibility that a veteran has. But VA loans across the board offer the best interest rates available on the market. There's a ton of 2.25 to 3.25% interest rate loans that still are out there from that same time period, 2020 through 2022. In most cases, there's no VA funding fee, which essentially is the VA's version of mortgage insurance. And which is a bit surprising is that assuming a VA loan is not limited to veterans. Any buyer can assume a VA loan if they qualify. Now, a big reason why a veteran wouldn't want to have their mortgage assumed by the buyer is because the veteran may lose entitlement unless the assumption is done correctly. Let's say the max conforming loan amount is $400,000, which of course now it is much higher, but a veteran could come in to a sales price of $400,000 with 0% down payment, and that would use up all of their entitlement. Let's say that they bought a house for $400,000, they now have zero entitlement, which means that if they were to purchase another property with the VA loan, they would have to come in with a down payment instead of enjoying the benefits of a 0% down payment on a VA loan. If they had a non-veteran assume this mortgage from them, then they would not receive any of their entitlement back, so they would have to come in with a down payment on their next purchase. However, if it was a veteran that was assuming the VA loan, then there's a process that they can go through where the veteran who is having the loan assumed could get their entitlement back if the process is done right. Another part of this is that the VA themselves has to approve the assumption. The VA, as you might have heard, have their own turn times. They take their sweet time, and we were talking 60 to 120 days. You're probably going to be on the back end of that if you're going with a VA loan. And then same thing applies as these other loans where there's large equity gaps that apply for all of these assumptions. Then with the USDA loan, a USDA loan is a mortgage program that is backed by the U.S. Department of Agriculture. And this is the loan type that in general has the lowest debt to income ratio available, which means that buyers qualify for the lowest sales prices when looking at the various loan types. So USDA loans, you're working an uphill battle with that. USDA loans are really designed for rural markets. So if there's a property that's a little bit out in the sticks, but it doesn't even have to be out in the sticks, basically anything outside of city limits, you can go to the USDA property lookup website and it shows the zones that qualify for USDA. You might be surprised at some of the areas that qualify as USDA. A big benefit of a USDA loan, similar to a VA loan, is that there's no down payment required initially. And so with the VA loan, USDA loan, since they're bringing in no down payment up front, this could keep the mortgage balance relatively high, which means that equity gap that you're having to come in with could be smaller than with the FHA loan. Some downsides of the USDA loan are their location requirements. If you're looking to buy in the city, a USDA loan is not going to be able to help out there. The income cap, as I described, is going to be the lowest out of all of these loan programs. And there's actually a hard cap on USDA income limits when looking at the average area media income. And par for the course, USDA servicing is slower, so the assumption should likely take months. So why are conventional loans for the most part not assumable? We talked about investors looking to make their returns and that it wouldn't make sense for the big financial picture overall if they were just allowing people to assume these low interest rate conventional loans. However, on most conventional mortgages, there's something called a due on sale clause, which means that if a property were to be sold, then the conventional loan becomes due at that time. If ownership of the property changes hands, that mortgage has to be paid off immediately. This protects investors and mortgage-backed securities, and this prevents taking over lower interest rates when market rates rise. As interest rates rise, lenders want to get more mortgages with those higher interest rates because higher returns for those lenders. Conventional loans are built for investor yield, and when you're talking about yield, that just essentially means profit. And conventional loans are backed by private lenders and investors, and most conventional loans follow the guidelines of Fannie Mae or Freddie Mac. Fannie Mae and Freddie Mac are GSEs, which are government-sponsored entities. You might think that they're government-owned, but the government just essentially backs these public entities. You can publicly trade Fannie Mae or Freddie Mac on the stock market. Digging into it a little deeper, these investors rely on expected returns based on current interest rates. So if a buyer could assume a 2.75% conventional loan in a 7% market, that lender loses huge amounts of expected interest income. The mortgage-backed security then loses value, and investors would be taking a massive financial hit. So that's where private lenders put these protections in place, like the due on sale clause. And just think for a second, let's say that millions of these 2 to 4% loans from 2020 through 2022 suddenly all become assumable. No one would ever originate a new loan at current rates because they would just be swapping these super low interest rate mortgages at night and day. Like no one would have to get a new mortgage. Loan officers and lenders would lose billions, mortgage-backed securities would collapse, and the entire financial market would implode, at least the housing market. The current financial system just is not designed to handle this. And I know that we saw, people in the government today say that they're going to look into conventional loans becoming assumable. I mean, that's just another headline. That's never going to happen. Now, in researching for this video, I learned that a majority of conventional loans are not assumable, but there are some that are. So I was trying to figure out, what conventional loans might be assumable. This is kind of funny here. And this snippet here states that the servicer is authorized to allow transfers of ownership for the following first lien mortgage loans if all of the criteria listed below are satisfied. And it basically explains that all ARMs are potentially assumable. With an adjustable rate mortgage, the lender is getting the benefit because the consumer is taking on the risk of an adjustable rate. However, it would become non-assumable if that had been converted to a fixed rate mortgage loan at some point. The other conventional loans that are potentially assumable are fixed rate portfolio mortgage loans that Fannie Mae purchased under commitment contracts dated before November 10th, 1980. 1980, as we know, is 45 years ago at this point. So if there was a 30-year conventional loan fixed rate mortgage that was originated before 1980, it's already gone, meaning it just doesn't exist. So there's no loans that you can essentially assume if they're conventional. Now let's get into the case study of a scenario of how an assumption might work. This is specifically for a VA loan. Let's say that a veteran bought 0% down payment in 2020 for $500,000. They currently have a 2.75% interest rate on a VA loan. Their current mortgage balance is at $430,000, paying down the principal over the past 5 years. And at the same time, this is what we've seen just across the board. Over these past 5 years, we've seen some heavy appreciation. That home value has now gone from $500,000 up to $600,000. And that buyer wants to assume the current $430,000 loan amount at a 2.75% interest rate. The buyer's current equity that they're looking to get out of the property from the sale is going to be the $600,000 current sales price minus their balance of the $430,000. So they currently have $170,000 of equity that they're looking to get out of the sale, which means that for the buyer, instead of coming in with a 0% down VA loan, purchasing a $600,000 sales price at current market rates, which would be like, 6%, in order to get this 2.75% interest rate, they would have to come in with $170,000 out of pocket in order for this scenario to work. And there's various ways that the buyer can come in with this cash to close. One would be if they have the cash or the savings saved up, $170K. Another option would be a second mortgage or a HELOC, which is a home equity line of credit. Note that a cash out refinance wouldn't work because with a cash out refinance, you're paying off the existing mortgage and getting a new loan balance at a higher amount. So you would have to get a second mortgage on top of that first mortgage at the 2.75 in order to potentially pull any equity out of the property. The only issue with this is that with most HELOCs, you're able to go up to in general up to 90% of the value of the property. So you would have to come in with like an 80-10-10 structure, which is a 10% down payment, a 10% HELOC, and then an 80% loan to value. A couple other options are seller concessions, which is highly unlikely because why would the seller give the buyer any of their equity? And then lastly, that buyer could get gift funds from a family member to make up the difference. So even for this scenario, which is very realistic over the past 5 years, zero down payment, just the standard appreciation nationally, think of how many buyers, and especially first-time home buyers, would be able to come in with $170,000 out of pocket to make something like this work. Now, if you yourself have assumed a mortgage, please let me know your scenario in the comments below. I'm curious to see how that went. But again, to summarize, some of the pros and cons of an assumable mortgage is that the potential pro is that you can get a lower rate, which leads to a lower monthly payment, which means lower interest paid over time. Potentially easier to qualify because with a lower rate, lower payment, lower debt to income ratio. And if they're able to make it work, this could be a huge advantage to buyers in the long term with the lower interest that they're paying. The cons of it is that they still have to qualify, the long lender approval time. You need to cover the seller's equity, which could be significant. The assumption is not available on conventional loans. And then, like I mentioned, 23% of loans are potentially assumable, but there's a much smaller percentage that are actually assumed on a purchase. So with that, thank you for watching. If you have any questions, thoughts, opinions on assumable loans, again, if you've done one in the past or if you have one coming up, let me know your scenario. I'm curious to see how you were able to make it work. And if you're looking to purchase a home or refinance in the next year in Washington, Oregon, California, Idaho, or Arizona, make sure to reach out to myself, Connor Webb. You can visit lenderconnorwebb.com, and there's my contact information right there. Make sure to like and subscribe to this YouTube channel for more mortgage and real estate content, and we'll see you in the next one.